Imagine walking into a bank, excited to buy your first car, only to be told you don't qualify for a loan. You've always paid your bills, you work hard, and yet they say your credit score isn't good enough. But what is a credit score, and why does it have so much control over your financial future? Let's take an example. Sarah, a 25-year-old teacher, wants to rent her first apartment. She finds the perfect place, but the landlord denies her application because of her low credit score. She's confused. She's never even borrowed money before. What she doesn't realize is that her lack of credit history makes her a risk in the eyes of lenders and landlords. A credit score is a 3-digit number that represents how trustworthy you are when it comes to borrowing money. It ranges from about 300 to 850, with higher scores showing that you're responsible with credit. Banks, credit card companies, landlords, and even some employers check this number to decide if they can trust you to make payments on time. A high credit score can open doors to better financial opportunities, while a low score can make life more expensive and limit your options. So how is this number calculated? Let's break it down. One of the biggest factors is payment history. Every time you pay a bill on time, it helps your score. But if you miss a payment or pay late, your score takes a hit. Lenders want to see that you can be trusted to pay back what you owe, so consistency is key. Next is something called credit utilization. This is the amount of credit you're using compared to your credit limit. For example, if you have a credit card with a $1,000 limit and you've spent $900, that's a 90% utilization rate, way too high. Lenders see this as a warning sign that you may be relying too much on borrowed money. A good rule of thumb is to keep your credit utilization below 30%. The length of your credit history also matters. If you've had a credit card for years and used it responsibly, that helps your score. That's why keeping older accounts open, even if you don't use them often, can be beneficial. Another factor is your mix of credit. Having different types of credit, such as credit cards, car loans, and mortgages, shows that you can handle multiple financial responsibilities. But taking on too much debt at once can have the opposite effect. Finally, every time you apply for a new credit card or loan, lenders check your credit report. This is called a hard inquiry, and too many of these in a short time can lower your score. However, checking your own credit score won't affect it. In fact, it's a smart habit to monitor your score regularly to make sure everything is correct. You can check your score for free through many banks, financial apps, or credit bureaus. Now, what if your credit score is low? Don't worry, Sarah was able to improve hers, and so can you. The first step is making payments on time every time. Set reminders or automate your payments if needed. Next, try to pay down your existing debt and avoid maxing out your credit cards. If you don't have much credit history, consider opening a secured credit card or becoming an authorized user on a trusted family member's account. Over time, responsible credit habits will improve your score. A good credit score can mean the difference between getting approved for your dream apartment or being denied. It can help you qualify for lower interest rates, saving you thousands of dollars over time. Even some employers check credit scores before hiring. Understanding how credit works gives you the power to build a strong financial future. Check your credit score today and start making smart financial choices. And if you found this video helpful, don't forget to like, subscribe, and share it with someone who needs to learn about credit scores.
Got a question about how something really works? Drop it in the comments and we might cover your topic in our next video.